This podcast is brought to you by the Resolve Long Horizon Investing Masterclass, a 10-part evergreen podcast series where Adam Butler, Mike Philbrick, and Rodrigo Gordillo of Resolve Asset Management Global explore an advanced investment framework specifically designed to steward quasi-permanent capital with humility and balance. From the science of decision-making to all-weather portfolio construction to the value of diversified alpha and tail protection, this series provides a comprehensive capital management roadmap to improve outcomes for wealthy individuals, advisors, family offices, and institutions managing less than $10 billion. To listen to the series or read the transcripts on demand, please visit investresolve.com/masterclass. Alternatively, you can find it on your favorite podcast player by searching for Resolve-Masterclass.
All right. We are live. Welcome, gentlemen. Brandon, Brian, and Adam, of course. Adam, cheers to Friday night drinks and happy hour, talking everything crypto. But before we do, Adam, as a CIO, do you want to give us a main disclaimer?
Sure. This is for entertainment purposes only. None of what you're going to hear today is advice. And you should seek advice from a professional that is familiar with your situation before partaking in any of the suggestions covered in today's podcast.
All right.
How was that?
That was fantastic. So welcome, Brandon, Brian. Before we get going in the many topics that we want to cover, I think it'll be useful for you guys to give a bit of your quick backgrounds and what your current projects are, and then we'll get into it. Whoever wants to start first.
I'll take the first stab at it. So I'm a co-founder of Cartan Group. We're a fintech consulting company based in the Cayman Islands. Most of our clients are focused on some layer of the crypto stack, whether it's a network in and of itself or a value add token running on top of it. And then we also have a side project called Code Cayman, where we offer free technology literacy training. We run, I think, about 7 different courses in that, and we offer it to the island and run around the island getting sponsorship to provide these programs.
Go back a little further than that, though, Brandon, because I know you've got a background in finance, right? Like you did spend 10 or more years in finance, operations, back office, tech, et cetera. So let's hear some about that.
So my background, I'm a software developer. I moved to the island 13 years ago, built a software team at a hedge fund management company, a fund governance company on the island, and then moved to a couple of banks. My last role was CTO of a private bank, and in there we built a crypto custody solution, and we launched that in 2017. We built it in 2016, and ultimately I just kind of wanted to be closer to the bleeding edge, so parted ways with that firm on very great terms. Still speak all the time, and decided to get closer to the bleeding edge of it. But yeah, my background, 3 different banks. I built a system for end-to-end an insurance company. I did a social media startup at one point in time that didn't work out so great, but we had a good time and had a lot of fun.
Great. Now, what about you, Brian? I know your background's also in more involved in the actual investments, traditional investment world.
Yeah. So I grew up in Toronto, Canada. Worked there for a couple of years for a private equity / hedge fund, looking at early and junior natural resource explorers. After a couple of years, moved down to the Cayman Islands to work for a private bank, where I worked very closely with the managing director on a number of different projects throughout the bank, all from making things more efficient to trying to maximize revenue generating opportunities for the bank. And then after a couple of years there, moved on to a family office, still in Cayman. So I've been in Cayman for 8 years now, and don't want to move away after being here for so long. But at the family office, I looked over a lot of the investments, existing investments when I joined, and also new investments while I was there. And then after that, moved to Sterling, where Brandon and I did a virtual asset custody platform under a regulated institution. So that was the first and only one at the time in the Cayman Islands. From doing that, and as Brandon mentioned, we after about a year's time, we wanted to get closer to the bleeding edge and work with companies in this area, both help them and be more in that industry. So that's when we started a Cartan Group about 2 years ago now. And now we have a team of 7 in the Cayman Islands and about 7 overseas as well. So that's been what we've been doing for a couple of years now.
2 years. That's like 10 dog years in crypto land, right?
It's Doji.
You guys are veteran.
Doji land.
Doji years.
Doji years. This is why we thought it would be really good to have you guys on, because it's a really neat mix of backgrounds in both sort of the front office and the back office for finance, and several years in the nuts and bolts of crypto. And I think it might be useful, Brandon, you said something about the full crypto stack. So maybe can we pull on that thread and maybe what's involved? What are the layers in that stack? How should we think about that?
Sure. So I think mostly how I think about crypto, a lot, actually, let me just back up. So another way to think about it is a software product of sorts, right? There's all these levels, which, everybody focuses on, the software engineers have built this great product, but there's project managers, content creators, content writers, product managers. And so I think of sort of the crypto stack in the same analogy where, there's a core network, right? And that's kind of a layer 1 network or a layer 2 solution on the layer 1 network. And so you can consider that Ethereum, AlGoran, Bitcoin, and then people start building on top of that stack. So you start creating NFTs on top of a network, or you start creating other products within that environment. And so you start stacking up things on top of everything else. And a great kind of analogy or piece to how this works is thinking of your actual computer. So you kind of have this hard drive and this motherboard and the CPU and everything else, and then somebody's written a bunch of drivers to write data to a hard drive or keep track of memory inside of RAM. And then, of course, I write on a layer on top of that where I don't write a driver and keep track of all the pixels on the screen or all the information on the hard drive. I just say, hey, operating system, give me this information. So when you look at the stack, the crypto stack, and you look at, let's say, AlGoran's network or Ethereum's network, you say, all right, they wrote the operating system of this network now, and they've aggregated a bunch of users into this with assets, capital, and so now I can tap into those things, whether we're calling an asset, something that has tangible value or non-fungible. It's all blending into one at this point in time, but you sort of have the network of people with assets, and you start layering different functionality on top of that and providing different opportunities for people to capitalize on it. And I guess when I say assets and capitalize, I generally don't always mean it in terms of this converts into X US dollars or X fiat currency. I generally mean it in the term of value creation. And what's the value of me being able to participate in some activity, and does that translate into other activities or other value creation activities, I should say.
So unlike sort of the internet, there are several versions of the base layer in crypto, right? And to my understanding, they serve each of the different potential base layers or chains or what have you. They're built to serve different purposes, right? So, and there's also sort of Bitcoin as the original base layer, and then others have evolved over time to fill gaps that were recognized in Bitcoin's kind of operating system, for lack of a better word, right? So how should people think about the evolution of those base layers through time? What are some of the gaps that the Bitcoin base layer has that other protocols have closed over time? And then where are we in that process, do you think? By the way, I asked Brandon, but Brian, chime in, obviously, wherever you have something to add.
Brandon, go ahead.
So I think I wouldn't. I think the original version, right, the Bitcoin network, when launched, was solving a single solution, which was creating a internet of money, or an internet money that can transcend the world, right, without borders. Sort of, if you look at the internet economy, it needed a value system, and Bitcoin fulfilled that role originally. And of course, it was super early, and you sort of had to move this transaction to over here. And what the second version of the network gave us was programmable money. So Ethereum sort of allowed us to write software. And the difference is Bitcoin sort of serves a single purpose, which is send value from here to here. Ethereum sort of creates a platform to say, send value from here to here if this happens, or if that happens, right? So we can create some base logic around what those things are. The two of them, I guess that there's multiple iterations before Ethereum, to be sure. But if we just kind of put a fork in that and say, or put a flag in it and say Bitcoin was 1, Ethereum potentially was 2, now you're starting to see sort of the third engine come out, which is same functionality as Bitcoin, same functionality as Ethereum, but way more speed, right? And so now we're talking thousands of transactions per second on some of these new proof of stake networks, and we're starting to create the actual requirements of a financial system on these networks, right? So we went from single use case to a platform. Both of those use cases sort of got to hundreds, tens of transactions a second. Maybe you can argue a bit more, but now we're talking thousands of transactions per second, and so that sort of equates the requirements of a financial system at scale globally. And so I guess the final piece now that's kind of coming together, and what I've recently started seeing pop up on all my feeds, is the crypto singularity, where everything starts to converge and starts to look like some crypto value chain of some sort. So as you start looking at the creators, social media content creators and influencers, there is starting to be a push to monetize their content and their strategy and let them own it. That moves into a crypto singularity. The financial services sector starts moving into this crypto singularity, and with the advent of these algorithmic or fiat-backed stablecoins being the key word there, we're starting to see some stability on moving into and out of an asset, but also we have all the volatile assets for us to really participate on at the same time.
So can I just go back to layer one, the Bitcoin, the Ethereum having a certain use case, and then the next evolution being the same idea but faster? What I'm curious about with regards to both Bitcoin and Ether is that, was it a feature or was it a bug, their inability to transact at the volume that we're seeing today without the excess costs?
Sorry, Brian, I'm doing most of the talking. I don't consider it a feature or a bug. I consider it a state of the first version of these things to come into production, right?
Was it just lack of foresight then, that they never expected it to be this popular, especially Ethereum?
No, I don't think so. I think let's go back to your first mobile phone, to RIM, to the iPhone, to the iPhone 12, right? Like, you got to start somewhere, and that's kind of Bitcoin, and it solved a huge issue where it brought peer-to-peer networking and cryptography together to create unique value. That's sort of the first solution, the first attempt, and the nature of technology is that it's an iterative process. And at the point in time that Bitcoin came out, it was a perfect scale for the size of the market that it was. And so it wasn't over-engineered, it wasn't under-engineered, it was perfectly engineered for that market segment at that time.
And then I would just add to that, there was a famous, I wouldn't say battle, but a disagreement amongst people in the Bitcoin community on the size of the blocks in the network and how there should be more transactions or a bigger block size per block to allow for more transactions in that area. And I think from the outset of that, one was Bitcoin. What came out of that was Bitcoin Cash. I don't have a kind of opinion on either or, but based on price, you can kind of determine that Bitcoin, the original lower size blocks, is currently winning. So in terms of that community trying to get more transactions faster, I don't think it has been a big detriment to its adoption.
One of the things that sorry, Rodrigo, finish your thought. Yeah. One of the things that distinguishes between Bitcoin and where Ethereum, it looks like they're trying to get to, and other networks, is this idea of Bitcoin relying exclusively on proof of work and a lot of energy engage in trying to migrate Ethereum towards something called proof of stake. And then there are other models that, like Chia, for example, which has an entirely different way of proving the validity of transactions. Can you maybe go into the difference between proof of work and proof of stake and the relative merits of either method?
Sure, I'll go again. So proof of work does require some energy. There's, it's hotly debated how much energy and impact and global, climate change and things like that. But I generally look at the so what it is you have to effectively run a mathematical equation and just iterate up on that mathematical equation until you find some random number that will make the block start with a number of zeros, right? So that basically starts at 1 and then goes and iterates up to 2 and 3 and gets to 1 trillion, and so we sort of found some random number in between there, and that's obviously a very expensive process for a computer to run through. And of course, then you get thousands of these guys all competing, because the first person that solves that, right, it's a very competitive environment, and the first person that solves it gets a big reward to do that. You can theorize or philosophize on the merits of it. At the end of the day, there's two sides. There's 2 points to this argument. One, you can say, well, it's wasting a bunch of energy for a financial system that we don't need. The other side is it's a financial system, and if you kind of equate all the financial system, banks and other infrastructure that's currently running, right, like that probably sucks up more energy than Bitcoin currently does. But also, you can say it's an incentive to get renewable energy, because ultimately the folks that are running these massive mining operations are highly incentivized to minimize their costs and to go chase places that provide minimized energy. You ultimately probably get to a renewable energy source to provide that minimized cost. So you're taking energy, you're storing it into something which is Bitcoin
information,
and then you can use that energy again in some other thing, or buy a house or whatever it is, right? So there is an argument on both sides that mining is a waste of energy. The flip side to this argument is the mining industry is sort of on the back end of the rest of the crypto community, right? Everybody focuses on Bitcoin mining energy requirements, but if you look at some of these other networks that are coming out that are running on proof of stake, like they're not requiring much energy to do these things. And so the argument starts to fall apart that, we can't do crypto because it takes too much energy to do. And so if you look at like an AlGoran, or you look at Ethereum when it switches to staking, the requirement, I run multiple nodes that are staking nodes on my laptop, right, on one of my spare laptops. It doesn't have any extra energy requirements. The fan never goes on. I have an archived version of that entire system. And so it competes and it contributes to the network at the same value add that one Bitcoin miner would. So you kind of look at these things and go, well, this is solved. Anybody that wants to participate in what we can call a energy efficient operation, go participate on Ethereum staking or AlGoran or Solana or something like that. But I think, to one of Brian's earlier points, when you look at the price, right, one of them is working very well, and everybody else is fighting to start getting their toes in the water.
So if we invent cold fusion and energy is abundant, and there's no scarcity value to the energy input. I'm just, I'm dreaming. We could also go down the quantum computing angle as well, but that's less interesting. But if we suddenly invent cold fusion and energy is no longer scarce, does that challenge the proof of work model?
The question really is, all things equal, if energy is not an issue, is one more secure than the other?
Well, I think that gets into kind of the more of a belief right now of if you believe the proof of work, I would say algorithm or rules are more secure than a proof of stake rules or algorithms. If you look at in either scenario, the algorithms, there are various different kind of not alternatives to proof of work, but different algorithms of how that occurs. Similar to proof of stake, you have various different networks that are proof of stake, but have different ways in which it generates consensus and gets everyone to agree on a history that is immutable. So I would say at this time it's kind of what you kind of would believe in. I think it's still very early, so I don't know who the winner would be. But if currently the market is saying that proof of work, even with all these concerns that I think can be explained, is still currently the go-to market leader.
And I guess there's always the risk of the new proof of stake technologies haven't been around as long as Bitcoin, which means that any exploits that the founders of that particular protocol might have not thought about, there may be holes that might still be found in the future. Whereas Bitcoin has been around so long that we kind of know it's pretty secure as far as we've seen.
Security is a fairly abstract concept in the way we're talking about it, right? Because effectively your attack points are, can I rewrite the balances of a chain, right? And so in order to do that, you sort of fork this chain, convince everybody that these new balances that you've done are correct, and sort of and push it back out. And proof of stake or proof of work, there's attack points on both, but the sound math behind the cryptography of it is solid, right? So you can sort of say that the 2 points of attack that you're looking at are, can I amass enough wealth and attack one of these consensus algorithms in order to fork the current version of the general ledger, right, of the chain, and then rewrite balances and reassign value to other contracts. Like that's the main thing that we're discussing, I guess, if we're talking about security. Mm-hmm. And I think when there's either, when Bitcoin was at $1 trillion, I'm not sure, I don't really watch the price of any of these things, but if Bitcoin's at $1 trillion, then you can assume that there's $1 trillion reward, right? And if you're at Ethereum and it's at 300 million or 5, I literally have no idea what the market caps of these things are, because I just really don't track. That's Brian's expertise. But if it's 400, there's a $400 million reward. If it's $10 million, if it's $1 billion, if it's $400 billion, these are the reward points to go and attack. And the math is sound across all the networks, right? It's the same cryptograph where nobody's inventing a new cryptographic engine or algorithm to do the math. So really you're talking about rebalancing or rejigging value assignments. And if that happened in one scenario, the entire thing would crash, right? If Bitcoin if you saw anybody compromise a value in Bitcoin, in Ethereum, in AlGoran, in Solana, any of them, you would see that entire network fall apart immediately. So there are attack points, and the proof is the bigger the network, right? The risk in financial services is, do I trust this entity or organization or institution to control my money, report, and go from there? The risk point is starting to switch to, do I trust the engineers that built this network? And the validation of that trust starts to show up when you start getting to some critical mass. How much money, how much value is this thing worth? Because you can assume state actors are attacking those networks at all times, right? So the more population growth inside of a network, the more value it becomes, the more attack points it becomes, the more safe you feel, the safer you feel as knowing that it's not being compromised in a public manner. Because if it was compromised, it'd be immediately obvious that happened.
So let's go down the stack a little bit. I know that you guys work with AlGoran quite a bit, and I want to understand. So you got ETH is doing this major series of transitions to try to become more competitive and less costly to transact in. They seem to have the second biggest network effect in the crypto space, and you have a lot of developers and projects within the Ethereum chain. But I think we don't know when these changes are going to come, and you have these competitors such as AlGoran, Solana, and a bunch of others that are all kind of trying to take a bigger stake. What is it about? Let's use AlGoran as an example as to what it's solving that Ethereum is trying to solve, or may be trying to get better with ETH 2.0 and the like.
So I would argue the solution AlGoran has brought to the table is they were the first kind of to come out with a true proof of stake model. I would say the argument that they're really solving is, here's the current financial system, right? Here's every swipe of MasterCard, Visa, American Express. Here's all the interfaces that tap into that globally. What AlGoran has done and said, we can't create a crypto network unless we can mimic the current base requirements. And so their transaction speed allows us to create the financial system at a global scale, right? And I think that's the most important piece, is the global scale, right? Because currently, most people's thinking is confined to their geographical proximity to something. So maybe I'm confined to, hey, I'm trying to do great for Cayman, and I'm trying to bring business into Cayman. Or if I'm from Toronto, so I'm a big Canadian fan, and so maybe I'm trying to build value in Canada and bring business into Canada. But all of a sudden, I've started, by having that thought pattern, I'm starting to limit my addressable market. And so now what AlGoran's system has given us the ability to do is tap into the entire internet as an addressable market and do financial system level transactions, the quantity of the financial system transactions globally, right? And so I can have, if I'm a content creator, I can have an audience that spans the entire world, and I can have immediate access to capital as they give it to me. Not swipe, wait 7 days, shows up in my bank account for a 30-cent transaction or a fractional of a cent transaction. So all of a sudden, we start getting all of these new opportunities, and the base requirement for those opportunities is speed. And networks like AlGoran, this next layer, this next version of these networks, are starting to provide that speed like nobody else.
And why would somebody choose something like AlGoran instead of the layer 2 and 3 that are being built on Bitcoin? Like the analogy that's used is that you got in the United States, you have all this money that's actually not transacting at level 1. I think it's called FedWire, right? Where it takes, when you transact, it actually takes 6 months to go from one user to the next. But in between there's a series of layers that allow it to feel like you've transacted instantly, like your Interact card or your Apple Pay. if these layers are being built out in Bitcoin, why would something like AlGoran be better or useful?
So I would say that the most secure. So one is, I think, security. The most secure a network is at its base layer one. When you start going and building layer 2, layer 3, layer 4, it gets way more complex and potentially less secure than layer 1. In terms of AlGoran being potentially a better network to use than Bitcoin for kind of the global financial services infrastructure, is one that, as Brandon said, it's fast. So block time in AlGoran are about 4.5 seconds, whereas somewhere like Bitcoin is 10 minutes. So they can also process more transactions per second at this time, and they have a great engineering team that is continuing to get that number higher and higher. The transactions on AlGoran are, I guess, cheap or inexpensive. So it costs 0.001 algos for each transaction. Algos is probably about $1 right now, so you're at less than a penny per transaction, whereas in Bitcoin that could be $5 to $10, even though it's still very low, just inefficient for micropayments or many payments at low values. And I think the kind of final thing why something like AlGoran is a bit better is for finality, meaning the way the consensus algorithm works in different networks is there's a way that all participants agree on what has happened and the history of the ledger. In networks like Bitcoin, it takes time. So you might be aware that whenever, if you open an account in an exchange, they will wait for 6 confirmations in the Bitcoin network before they will actually credit you that Bitcoin for you to use, because there is that possibility of call it different chains or other chains to get longer, so therefore it gets reversed, and therefore that transaction may or may not have
actually get caught holding the bag.
Yes. Whereas in AlGoran, after every block, 4.5 seconds, the way their algorithm runs, it's final. There are no possibilities of other chains, other transactions, other networks. That has happened with finality. So I think those 3 things are why I believe AlGoran makes a bit more sense at this time for the global financial services.
Why don't we see more rapid adoption of some of these newer protocols? Is it the Betamax VHS conundrum, right? Where it doesn't really matter if the technology is vastly superior, if there's enough of a head start in terms of network effects, right? If a sufficient number of people have adopted a protocol, then it doesn't really matter if a new and better protocol comes along that does all of the things that the old protocol does and infinitely better. What do you think is holding some of these newer, better protocols back, or potentially better protocols back?
So the obvious answer is network effect is definitely that's the elephant in the room. But I do argue that, in my opinion, there's going to be millions of coins across the world, and they'll be built on all sorts of different networks. And so it'll become a proposition it'll become an engineering question. Well, I need to have this, and this is what I need to have access to. What's currently happening in the ecosystem is that soon we're going to have cross-chain transactions. So I'm going to be able to go from AlGoran to Ethereum to Bitcoin back to AlGoran over to Chia and Solana and whoever else. And so once that sort of happens, it'll become it'll sort of, I theorize that it will sort of dissipate the network effects of any one network, because now to become an engineering question, what's the best platform for me to build on? Okay, that's great that there's 100 million users over on that platform, I can still get access to them, right? And so now we'll have cross-chain functionality that gives us access to that network, bring it over to this network. All the networks will start to be intertwined with value creation amongst them, and then the entire ecosystem starts to go like this. Every network you're seeing right now get built is basically a platform, right? It's no longer just single use case like Bitcoin. But Bitcoin obviously still continues to be the market leader in terms of percentage that it outweighs against everything else, in terms of market cap, in terms of value per asset. But Bitcoin is hard to make as programmable money inside of all these contracts and everything else. So eventually people will start wrapping Bitcoin out of the network onto Ethereum or onto AlGoran, and we'll start pulling those users into all different networks. The reason crypto will be, you'll know that crypto is the value transfer agent, crypto networks will be the value transfer agent when you stop actually hearing about crypto, right? So Linux, the year of Linux is coming in the late 90s, early 2000s. Oh, when's going to replace Windows? When's Linux going to be the desktop that everybody uses? Well, it happened, right? Every Android phone is a Linux OS. Most of the web is run on Linux, but nobody went, oh, that was the year. We nailed it. We got the year right. And I think, the same thing's going to happen in this environment where my mom isn't going to know that she's transacting in crypto. She's just going to be sending Canadian dollars around, right? So that's when we know, and then the network effect no longer matters anymore, because we're not even talking about the networks at that level.
So this is the interoperability that you're talking about, right? That these a lot of these platforms are making it. They're creating their own platform. They're trying to entice developers to come to their platform, but they're also making it so that it plugs in easily to other networks, so that there's going to be some easy access. So this is outside of the exchanges that currently you can buy and sell these different types of coins. This is more operating and creating the sinew within these organizations to be able to maximize usability for the end user.
Yeah, correct. The interoperability is probably the best word to use. Cross-chain transactions, another one. The networks themselves, right? Like Ethereum isn't building a bridge into Bitcoin, although there is a contract to do that. But what's starting to happen is another network is forming, right? So you have AlGoran here, you have a intermediary network here, and you have Bitcoin here. And this intermediary network manages the mesh, the interoperability, if you will. So they deploy a contract here, wrap a Bitcoin into that asset over here, and then control the asset, and then everybody can transact the way they so see fit.
What is an example of that type of network, the sort of connective tissue?
So they're starting to pop up now. So there's like the P network, it's P network. There's Elixir that's going to pop up fairly soon, and a few others that are kind of popping up around town.
Is it
around
FTX? Sam, I heard an interview with Sam from FTX. I think he's also part of that Elixir network, right? I think. Anyway.
I don't know off the top.
But those are that sits in between the exchanges. Is Polkadot one of them that does a similar thing?
Polkadot has it's not quite the same as Axelar and eNetwork, but it does have some cross-chain functionality in it. You can't do that yet.
So what distinguishes the crypto asset model from the Linux analog is that, Linus Torvald never really monetized Linux, right? Like he did through different channels, right? Through more traditional sort of wrappers around that operating system. But I mean, what distinguishes crypto is that you've got tech, and then there's a monetary value that is placed on that tech in the form of these coins that are traded, right? And so, like, is it reasonable? I mean, you guys have invoked this a couple times during this conversation. Just look at the market cap of Bitcoin. Obviously, the market believes that Bitcoin is the protocol of choice, or this or that, right? Like, is that the right way to gauge the level of adoption? And then I think a lot of people that are not in the crypto space, even I think some people who operate in the crypto space, struggle to try and connect the dots. Like, if you've got a security, a stock, then the theoretical value of that security is the cumulative sum of all future cash flows discounted back by the discount rate, right? What is the analog for that in the crypto space, other than sort of the value of a coin being sort of more an indication of a popularity contest than it's the voting machine as opposed to the theoretical weighing machine in traditional markets? Do you guys have any? Maybe Brian, you've given this more thought on the sort of money side of this whole thing.
Sure, I'll attempt to do my best on that side of things. So when you talk about something like stocks, where a share is supposedly the future discounted cash flow of that company, I would argue that some other asset classes don't have future cash flows. Like gold, like silver, like a lot of different commodities. But they still have an enormous amount of value. In terms of why certain units of certain networks have value, I think is the belief that you want to participate in that network. You want to have a stake in that network that you specifically believe in. This isn't my analogy. I read this somewhere and I really liked it, but Bitcoin can be described like a platypus. So when scientists first found a platypus, it had characteristics of mammals and amphibians, and they had no idea what to do with it. So they actually had to create a new category under mammals to put specifically the platypus type of animals. This person where I've read would argue that Bitcoin is like a platypus and has created its entire new asset. So I think it certainly has characteristics of what we currently know, but it is also something completely different. And that is, I believe, one of the hardest things to wrap your head around. And I'm still wrapping my head around it.
Well, I think it's, go ahead, Brandon. I have something to say after.
I think just to add innovation isn't something that when you innovate on whatever it is, it's not something you do and say, hey, how do I take this process and add a tweak to it if I'm going to do some sort of global innovation, right? And so you can kind of look at taxi services and software and Uber, right? Like Uber wasn't like, how do we buy 1 million cars and disperse them around the world and then we can have the call-in center and we'll do it. They were like, let's just aggregate all the clients and then we can convince everybody else. And so they created, they can convince all the drivers to then pick those people up. So they created a software system in order to aggregate users and then aggregate the drivers and basically run an exchange in the middle and match them. You weren't, so the same kind of what Brian's saying to your question is, we're not trying to build the stock market in crypto. We're trying to say, it's a stock. It's access to a network. It's got value. Its value is denominated somewhere down the line in U.S. dollars, but it's also how that network performs and what do you have access to within that network. It's a collectible. It's not a collectible. It's everything and there's nothing. It's all of the above.
Well, it seems to me that it is an emergent phenomenon, and we're going to see use cases that we could have never imagined. And one of the ones, let me give you an example of one that I think is a coin that legitimately has value in terms of expected future cash flows, but has taken advantage of the zeitgeist and the infrastructure of the crypto space in order to create a club of like-minded individuals that believe in a certain mission. And and are using this company's coin and also to get paid to be able to build out the network. And this is the Helium network, right? So the Helium network does something called proof of space. And so what they're trying to do is they're working in the Internet of Things, right? All the little scooters, the dog tags, find your phone type of networks that don't require such throughput as a cell phone, although I'm sure they'll get there. But basically they have a coin. You can buy yourself a little modem that you put on your window, and if that modem is at a certain distance to another modem, then you've created a peer-to-peer network. And that peer-to-peer network now can find those little scooters and tell the scooter company where it is, right? And so you can buy 2, 3, 4 of these. You can convince people to do it. You can create a business where you're buying 1,000 of these and making sure that they're spaced in the right place and put in the right ways. But every time that they create a task, they connect in a certain way, or they find a scooter, or they find a dog tag, they get paid in that company's crypto, and it's very cheap. The little machine costs like $500, and then you just start minting. You start creating passive income, and you can use that either to keep your faith in that company and become part of the group, and you get all these types of behavioral incentives to keep your money in that coin, or you can convert it to Bitcoin and you, in a way, mine at a 1/10 of the cost of trying to mine crypto. So that company is now, if you look at the network, it's throughout the United States. The companies are already paying them in order to use them because they're a lot cheaper than the internet companies. So they're disintermediating the traditional telcos, and they've done this through this incentive system that only exists in crypto, in a way that them going public in an exchange, in a traditional exchange, and just owning your company doesn't, right? Because they can't give out special perks. They can't decide to start burning their own coin in order to create scarcity and all these things. And so the behavioral finance side of it, combined with true use cases with future cash flows, and the players that are creating the interoperability, it's like a wholesale change to a new way of building capital, the capitalist society. And anyway, that's the way I see it.
It's sort of like using the network effect to commercialize a concept. And obviously, there's so many business models that depend on a critical mass of users in order for the full value of the commercial opportunity to be realized, right? Mm-hmm. So this protocol or this kind of approach facilitates capital raising and the sort of tribal network building function that is required to build these types of commercial ventures. It sort of bundles them in one, right? And so I think that's a useful metaphor that was helpful for me.
And just quickly, another one is the a cash network. Just quickly, same idea, but this time with cloud computing, right? You get
is that like the Cash app that Joe Rogan always talks about, or is this
no? It's Acash, AKASH. So a cash. You can either download some software and use allows a cache to use a part of your hard drive in order to create a peer-to-peer cloud computing network in order to compete against Amazon and Google. Or now they're going to start distributing these little boxes, these little small computers that you can plug into your computer, plug into your Wi-Fi network, or hardwire it in. And just by turning that on, you're going to get a cash coin, right? And you're going to provide a massive cloud computing operation that is also more secure because it's decentralized, and therefore your data is not subject to being in one single spot. Anyway, there's a lot in those. That's a legitimate business with cash flows that they're using crypto in order to incentivize, create those network effects, right? So it's a whole new world.
It's just Sorry, go ahead, Brian.
I was just going to say that those, like Helium, we're very familiar with Helium. There's a few of those kind of boxes on Island now, and like Helium, it's very interesting to I think what we'll see in the future, combine the, call it share or equity nature of a company along with its utility kind of all together in one. So I think a long time ago, someone was saying that it's like being one of the first users of Facebook, but also one of the first shareholders of Facebook. And as I use it more and as I get more people to use it, I'm incentivized because I own a share of it, and then I'm also incentivized because I can use them more if I wanted to. So that is a very I agree that I think that's a very interesting thing to kind of see how it plays out going forward with these new tokens and actually what they potentially can represent.
Yeah, that's very helpful. Brandon, sorry.
I think anytime you're talking about value, money, the traditional route up until 2009, 2010 has always been anchored in, effectively US dollars if we're going around the world. And there's obviously a whole pool of untapped people that have never participated in a global financial system. They just plainly haven't had access to it. And as these new business models evolve, they will give access to a whole portion of the world and create capital and wealth creation at a rapid scale that we've never actually seen before, right? So I anticipate large portions, or I speculate that large portions of the world's economy that currently aren't fully participating in the financial sector part of it are now going to start thinking, hey, well, if I can run a helium router in wherever country and start generating value, and then other people are, and you get a little network going, and then the dog walks by or the scooter drives by and it tracks some information, they're now participating and getting value and buying bread and milk. And I think a lot of people in first world nations discount the rest of the world, right? This is dumb. This isn't US dollars, or this isn't the world that we live in. Oh, they shouldn't be able to participate on Wall Street, and they can't buy into a hedge fund. And I think this entire population that's never contributed before, or never had the option to participate or contribute before, are now going to get access to new business models, and I think that's going to change. That's going to change the makeup of how people think of value, right? Value creation, value distribution, value dissemination.
You're tapping a brand new market to be able to access areas that they couldn't access before. So
Yes.
that helium thing, my father, there's like one helium thing in Colombia, in a place in Colombia, right? If you're a first mover on this and you get a bunch of helium thing, or you make your own and you start, that's what my father did. I'm like, you can make some passive income here. You get 10, 20 different guys in Lima, and all of a sudden, you got yourself a massive business, right? So that would never happen with a traditional model where the company itself has to go to Lima and figure out the legal logistics. No, this is purely driven by the network effect of crypto. And then the other use case in terms of tapping into a market is that 24-hour trading of some of the largest growth stocks in the world, right? When you have the other side of the world, retail, poor, that no broker in Peru wants to open up an account for somebody that has $20,000, right? But if you can get into the crypto space, now you can buy Apple, Tesla, and a wide variety of stocks. You can buy GameStop if you want in the crypto space. Peruvians can't do that. Now they can, right? So you're creating a whole new opportunity for the disenfranchised to participate in global growth in a way that only the rich could in recent history. That's another.
They pay a pretty massive financing rate to get access to derivatives that wrap around these stocks, right? In the end, the capital class will end up profiting from this far more than the poor, I think. But I do think that the distributed tech, ends up benefiting everybody in a way that is highly universally beneficial. So that's a fair point.
I mean, sure, there's always going to be arguably a pyramid, right? Of there's sort of always going to be a capital class like that way of putting it, and there's going to be everybody else building themselves up. But I think if, like in Peru, we deploy a small network of helium routers and we start giving them an extra $2,000 per month because they've minted a bunch of HNT, like that's a very big leap for some folk, right?
Oh my God, it's life-changing.
That's a huge leap. And I think that I agree that, I don't know if I agree, but yeah, some folks aren't going to go and deploy a helium router and then they're going to be, starting Apple or investing $1 million into Apple shares. But they are going to have a better community. in their society, in their geographical region, and they're going to be able to participate on a network that's global in scale. So maybe they start connecting with Lima starts connecting with some folk in Southeast Asia, or some folk in Africa, or parts of Canada, right? There's all sorts of areas in the first world that need some connection and need some upgrading in terms of that stuff. So
how does that work? Like, this all is highly reminiscent of the multi-level marketing type programs, the Avons and the New Skins and stuff in the 90s. So with Helium, if you are the first to bring a node, I may not be using the right language, but bring a node to Colombia, and then you disseminate this concept within Colombia, and 10,000 or 100,000 nodes emerge in Colombia. Is your node sort of the original node, and then you accumulate all of the value that, or is it okay?
No, so there's a point where you get rewarded for being the first and having a network on, period, full stop. And then the more you're able to connect with others, the better everybody does. Because
I
really,
see. Okay, because
point,
more
right?
transactions, so to speak, are going through your
the moment
router.
you create a legitimate, useful network, that's the maximum amount of revenue you can get.
Yeah.
Right. So, and there's going to be a point where you're one of the first. You get all the nodes, and nobody wants to be close to your node because it's proof of space. So, 200 meters at least in order to create some like proper distancing, and then. If you get too overcrowded, everybody suffers, to incentivize them to not put the routers close to each other, right? So there's a point where you're now going to start competing for space. But in the beginning, you're able to like maximize your revenues, and then you're going to plateau, right? And get to a certain level where the economics have to make sense.
Yeah, and the density of the population actually doesn't matter, right? Because
right.
you need to have a certain radius
right.
around you of space. So I want to make sure, Brandon, you've mentioned this a few times during our chat, but this idea of distributed value, where, for example, a musician or some sort of content creator is able to build a tribe and a brand and a community, and by virtue of bringing value to the people that are in that community, both the content creator and everybody within the community is incentivized to build the community, right? And we're seeing this more and more. Can you give some examples of this and how this is taking off and what the future of this model might look like?
So I think there's a very interesting project that I've been watching for a little, not very long, because it's only just launched. But it's called BitClout, right? So it's like a decentralized Twitter at this point in time. And the interesting thing is that everybody that registers effectively gets their own personal token in it, right? So I have an account, bitclout.com/Caruana, and so people can buy my token. And so as I create this network, I can start saying my network is literally worth $5. I don't have a big network. My market cap is like $16 because every time somebody they buy it, it mints it at that point in time, right? So I have no network. I'm not a very public guy. I mostly keep to myself. But as some of these influencers and some of these real content creators that are super talented start doing these things, their value, their market cap for all the value that they create, right? That people follow. I sell a vodka soda. Right, and so I'm selling, I don't Grey Goose, and they kind of pay me to do that. But now I can participate. I think you are going to be the next big deal in influential social media.
You're not alone.
I'm going to place a bet. Yeah, well, from everything I've seen, you guys are killing it. But I'd place a bet, right? I'd buy your token, I'd buy your coin, and of course, it's not going to have value outside of the ecosystem. In day-to-day life, but I might be able to hop out of my token into a parent token, into Ethereum, into US dollars, into gas in my car, or milk in my fridge, or maybe I'm a bit more influential and I can buy a house, or I can buy the car itself. So So I think that's kind of what's happening. I think BitClout is certainly the most interesting experiment in the space. The other one that I would look to on creating a network on top of one of these blockchains is Dfinity or the Internet Computer. I don't know a lot about it. I can't speak to it, but there seems to be a lot of activity and interest.
It's a wild project.
Yeah, and so I'm definitely not an expert. I can't speak to it, but I've started paying attention, right? So I'm going to start studying it and researching it and forming my own opinions over the next weeks or months on it. But I think that's another engine that might be able to do this thing. Of course, there's also NFTs, which are super controversial in some corners of the internet, and my corner of the internet, it's not so controversial. I can make sense of it. It makes sense to me. Just let people be and experiment, and value will get created inside of all of that. It's sort of when I say it out loud, it sort of feels like a kumbaya perspective. I'm not a kumbaya kind of person, but I definitely adhere to.
You bring out the best in people.
I definitely adhere to win and help win, right? The notion that it's the same. You're going down in a plane. You put your mask on first, and then you put somebody else's mask on. Well, I need to win, but I don't want to win by myself. I want others to win with us. So I'll fight. I'll fight for myself, and I'll fight for value creation around me with the folks that are working with.
Stop selling your BitClout token, okay?
Yeah.
No one's buying it.
No,
Just so I'm clear, I can buy your BitClout for $16. Is this the?
I think you can buy my.
You can buy him entirely for.
Is there a Brandon Brian cross trade that I can do? Like, is there something
That's
I
right.
can?
Short Brandon, long Brian. Yeah.
So Brian, I have a question. Speaking of like trying to win and getting this community to grow, when I first got into the space and I saw the potential, trying to get the onboarding from fiat to the space, and then discovering these stable coins that I didn't understand. Like, what can you give me a reason why stable coins work and how it helps with the whole fiat exchange?
Yeah, so I think there's a couple different categories of stable coins. The first one is certain companies. You can open an account with them, and when you deposit any type of fiat currency, they will give you or mint you new stable coins on a one-for-one basis. So somewhere like Circle US dollars or Gemini US dollars, every fiat you deposit, if you want to get their stable coin, all you have to do is, I think, push a button or something, and they will give you the exact same amounts. The benefits potentially with these stable coins, not in the fiat version, but in the tokenized version, is you can transfer them via the network that they are on. And I would say a lot of people think that this is, you can do this a lot quicker than current normal menus, and likely a lot cheaper as well. So those possibly two reasons why you would kind of exchange your fiat for these stable coins. Another type of stable coin, which I think is a bit more interesting and a bit more complex, are these algorithmic stable coins. So there are certain networks and protocols that have let's say, their own native asset like Bitcoin or Ether, but part of that network natively is also a stable type of currency. And there is a mechanism for that stable currency to be pegged to the one that is intended to be pegged, so to the US dollar, to British pounds, to euros, and the algorithmic nature of it uses that asset and the price of that stable coin to the actual currency it's pegging, and when it kind of either appreciates or depreciates, there's a mechanism to use that asset to buy, sell, and stabilize that stable coin price to the actual currency it is pegging to. And that's the very interesting area, and a lot harder than the one-to-one aspect of it.
So why do they exist? I mean, it seems like such an overcomplex process in contrast to something like Tether that claims to have straight up backed assets in US dollars.
Although it is pegged to the US dollars, the algorithmic stablecoin actually does not rely on a US dollar to, let's say, work. So in the one-to-one area, you have to deposit fiat dollars. There's a certain amount of fiat dollars that backs the coin that you actually get. But in this area, it is all occurring natively on that network or the network that the stablecoin is on. Although there is a target to currently a certain fiat currency, there is a scenario where that target may not be to a fiat in the future, and it still all happens natively on that network.
Without any fungibility, though, it seems like how do you maintain a peg without having some sort of fungibility to facilitate a conversion, right? Like do you have any insight in how does that work?
So in terms of fungibility, they are fungible. So one stable coin is equal to another unit of that same stable coin. So they are fungible in that sense.
But not fungible to the unit of the peg.
Correct. So you wouldn't, in the algorithmic scenario, there would be, let's say, no way to convert one of those assets to the actual fiat currency itself. But you would be able to convert to the coin that is supposed to be pegging that target currency.
And you mentioned like in some of them are pegged, and ETH and Bitcoin are used in an over collateralized way in order to create these to have enough assets to provide this peg, right? But then you can go to an exchange and exchange, for example, DAI for $1 US or close to it, and as the stable coin is trying to do that. But you could exchange a DAI, for example, for a portion of Ether and Bitcoin and USDC, I think is what they also collateralize with right now, just straight up.
Yeah, so DAI is a very interesting one. So they have a model where you do have to put in a larger value of Ethereum. I think they support multiple assets now, but let's just say Ethereum for now. And they give you a certain amount of their DAI stablecoin, which they have pegged to US dollars. Once you receive that DAI, that is an Ethereum token, and you can use it just like any other Ethereum token. You can deposit it to an exchange. You can sell that for Ethereum, for Bitcoin, as long as the exchange offers that type of stablecoin for deposit and for trading.
So in March of 2020, there seemed to have been a massive dislocation between certain algorithmic stablecoins and the peg. And so what is the risk in contrast to something maybe like, I mean, Tether has its own controversies as to whether they actually are backed by the dollar or not. But if we assume that they are indeed backed by a dollar, it seems to me like one is vastly more, at least from at first blush, vastly more less risky than the other. Like, what do you think about that? Those types of dislocations that we've seen in the algorithmic type of coins, for both of you, by the way.
I think there are pros and cons to both of them, right? So obviously the one that are pegged by cash, let's say, are a lot safer. But the other argument is that it is a little bit centrally controlled. So one or more people or a group of persons could likely censor transactions in that unit from one account to another account, wherever. Whereas on the algorithmic stablecoin side, there is no central party that can be able to do that. It is built in natively into the system. Now, the disadvantage is that you have to sort of trust that the algorithms will do as they say they will do. But ultimately, there may be issues that come up based on certain restrictions or how they've been programmed that may not work 100% as a market goes. The volatility of the market goes all the way up, both either up or down. So like in the recent drop, not March 2020, but I'd say May 2021, the crypto drop, there were some issues on some algorithmic stablecoins where the peg of $1 kind of went down to 95 cents, 96 cents for a little bit. And I was looking into one of them, and there was a restriction on the amount of on the algorithm to kind of sell, is either sell or buy, I can't recall which direction, that native unit to its stablecoin. There was a limit on the number it could do daily. So because of the large amount of volume immediately, they couldn't peg it sufficiently as quickly. If you look at it now, it's pegged back to 1-to-1 after giving it time to do that. So I'm sure that community will look at what occurred and make proposals so that if something like this does happen again in the future, they have better mechanisms to support that peg a lot quicker.
Okay, so just so that I can understand, the attractiveness of an algorithmic-based peg for the crypto community continues to be this decentralization belief system, right? That when you have a company that is running a portfolio of collateral, legitimate U.S. dollar collateral, that they have control of it, and not only that, I'm sure that the
like
government.
The Fed?
Exactly. The Fed can actually go into their bank account and say, we're seizing this money, and anybody else that. So there's a fear there that, again, central banks, centralization is a big issue, but at least you're pegged 1-to-1, assuming that they actually have the collateral. And then on the other side, you have the speed of transaction. I imagine that, I haven't done this yet, but maybe you guys can disabuse me if I'm incorrect. If I want to transfer fiat from Kraken to Binance versus transferring Tether from Kraken to Binance, one will be faster than the other, and not by a small amount of time. Right, so you got the algo-based stable coins are faster, they're decentralized, and they do have some issues with
to transfer
pegging at the worst
USD,
times.
like legit USD from one exchange to another, you'd need to do it through the SWIFT network, right? Like it needs to travel through the traditional financial system, right? So I guess you're getting the advantage of being able to migrate the fiat into these stable coins and then use the stablecoin tech to be able to affect the transfers. Brandon, you expressed an interest in wanting to talk about asset-backed coins, right? Are we sort of there? Is this a natural place to connect to that, or are we already covering that?
I think we're covering it. I think Brian is way leaps and bounds more knowledgeable on stable coins and things than I could never hope to be. The only perspective that I can add or really add value to Brian's point of view is just obviously building bank platforms for a couple of different times now. The international settlement is a web of a nightmare, right? It's basically a glorified FTP network. And so you put a file in a directory, it gets picked up, it has some routing instructions. It's literally a text file. You send a wire from New York to London, it's a text file. And it routes through a number of banks, which ultimately go from here to here to the Fed to set bank, and then to the final destination. And everybody extracts a little fee along the way. And effectively, there is no insight into when it left and when it arrived, right? It went into the ether. Oh, it got where it was going. And I can attest because I built these systems, right? So I'm very versed in how that piece works. The big value add that I kind of want to get across is, right, with an asset-backed stablecoin, it's the same thing as having US dollars, right? USDC, Tether, whatever, take out the controversy. I'm not speaking to it, right? But it's the same thing as having digital dollars on a ledger at Boney or Bank of America or Wells or wherever. And so when you kind of abstract it from that perspective, I can see it leave, I can see it show up within 10 seconds, right? Not, it went out into the ether for a bit and then it came back. And of course, this is not talking to interoperability within the US or within Canada, right? This isn't I'm sending a transfer from a Canadian bank to a Canadian bank or a US to a US bank. I'm talking about international wire movement. And of course, there's trillions of dollars that transcend international borders every day through the banking system, through the US financial banking system. And these asset-backed stablecoins give us, whether they're arguably, whether they're algorithmic or asset-backed, but I'm specifically talking to asset-backed in this scenario because it's quite literally US dollars in a bank account, in a trust in the case of USDC, right? Like, again, I don't want to speak to the controversies, but if we're just talking USDC, it's a regulated entity in a trust. Everything is back-to-back, and it moves way faster. And you can move it on any of the networks, from AlGoran's network to Ethereum to Solana. It doesn't matter. USDC lives everywhere and always. And if I was operating a financial institution outside the US that moved a lot of volume, a lot of assets, a lot of US dollars around the world, it would be more cost effective and more beneficial with more transparency to start considering using one of these asset-backed stablecoins that are in a regulated environment, so not the controversial ones. And that also negates or mitigates the risk of correspondent banking around the world. So if I'm starting to transact in USDC or something along those lines, that it's just a way more efficient way to move capital around the world. And capital flows down the path of least resistance. So if I can move and take advantage of something, and just in the scenario that you were saying, from exchange to exchange, way more efficient to move USDC than it is to exchange, go to US dollars, send to my bank, send another wire out to the other one, even if it's within the financial system, within the US border or the Canadian border, right? Like, it's way more efficient to do it this way. So capital.
It's just a new tech that allows you to transact in that particular fiat currency much faster, full transparency, full auditability. And I can't remember where I saw this, but the Asia's been on this for a long time, and I really understood the volume in stable coins when I realized that merchants in Asia were transacting through pure stable coins for traditional businesses, because they would shave off 5 days from the time that they had the deal, transferred their fiat to the other fiat bank. The other fiat bank needed to understand where it was coming from, what amount is. Like, there was a lot of AML restrictions that made it complicated, as well as the old tech restrictions that made it much slower to move around. But the big issue that I guess that needs to be addressed in this world is the AML process, even in those stablecoins, right? I mean, there's a reason why it's slower, is because there needs to be a check as to where these assets are coming from. Now you're shaking your head and you're going to tell me that I'm dead wrong about that. So please.
Okay, can I say before he argues that side, the ones that, so like Circle US dollars, to get an account, you have to go through KYC and AML. They need to know who you are and where you got your money from before they will accept your US dollars and give you Circle US dollars. Now, let's say I have an account at Circle. I got my Circle US dollars. I send it to you, Adam. You now have Circle US dollars. If you ever wanted to redeem those Circle US dollars back to US dollars, you would have to go open an account with Circle, and they would need to know who you are. So there is certainly a gateway.
They're solving a regulatory hurdle.
Yeah, there is that that part going from fiat to these stable coins and back. But now let Brandon do the argument.
I'm not going to argue the other side of it, but I just want to touch on kind of the barriers are not because of KYC to move capital around the world, right? Like, let's assume that let's assume that both sides, the counterparty and the party, are both KYC'd already on the nodes, right, on the network. The barrier is literally moving US dollars through an FTP server.
I totally agree. Yeah.
Right. So I don't want to. I'm not.
No.
KYC.
I totally agree. I think that that's the biggest objection, right? The biggest objection.
Well, hold on. I'm not sure that's the biggest objection, right? Like, there's definitely an objection about the strength of the collateral too, right? So, like, I want to dig into.
Oh, sure.
There's obviously a massive amount of like, and the position that holding USDC or Tether is like having money in a bank account, I think needs to be fleshed out, right? It's more like having money in an unregulated money market fund, where the money market fund is invested in commercial paper and a variety of other collateral sources. And so what I wanted, I know that's true for Tether. I'm sensing that that's not true for USDC, that their collateral is definitely more transparent, cleaner. So let's get into this collateral issue and how to distinguish between the different stable coins and their collateralization.
So I'm gonna make Brian sort of speak to that, and just before I do, Brian, just say, right, when you leave your dollars in a bank, right, at Bank of America or RBC in Canada or something like that, the bank goes and invests that money, right? Like,
it lends it out.
It's true, but you've got there's
100
a reason
times
why you've got deposit insurance, right?
Right, and 2008 was a great example of how great it all worked. Right? So,
but again, you've got deposit insurance, right? So up to a certain
up to $100,000.
Up to
sure.
a cap, right? So
for sure.
But Brian, to the element of how we're tracking and how that goes on, you're the smart guy, man.
Well, specifically for, I know Circle US sellers and Gemini US sellers, so they're both issue their stablecoin under regulated trust companies, and they, on a month-to-month basis, they have attestations performed by a accounting company to ensure that to ensure that their bank balances are what they say their bank balances are, and then you can compare that with how many tokens they've issued outstanding, so that you can, on a monthly basis, you can see that it's either 1-to-1 or not 1-to-1. So,
and they're either just holding cash in bank accounts, or they're holding T-bills or something, some sort of cash equivalent without credit risk, right? Like,
right.
They're not holding commercial paper like Tether is.
Correct. I know those two. I believe they just have it in cash. They don't hold any instruments. It's all just in a bank account.
Right. So, there are certain cases
Hopefully
in which there's
multiple
much more. There are certain cases in which they're much more transparent about what they're actually holding, the auditability, plus the KYC nature of it. So, but can I just go back and help me understand how? You have Circle, for example. You said I KYC'd in. I sent money to Adam to get that out. He needs to KYC out. But what if I KYC in? I send money to Adam. Adam goes to an exchange, buys some Bitcoin with it, then moves that to another stable coin and uses it for untoward purposes. I mean, that still continues to be an issue with being able to track
just purely
those
theoretical,
funds, right? That's right, purely theoretical.
Yeah, do we need to say that disclaimer again? I think we need to just do that
exactly,
one more time.
Yeah.
That's right. Yeah, that's a different type of disclaimer. But the issue is like the issue continues to be like being able to use these currencies for untoward reasons, and how crypto is facilitating that in ways that fiat may not, because of all of the KYC everywhere and anywhere, right? Everywhere you go, that you're going to use that money, even if you're taking it out in dollar bills. When you travel with over $10,000, you have to declare it, and if you're not, then you're a criminal, right? So you can do a lot more in the crypto space than you can do in fiat. So what's
I feel
the
like
rebuttal
Pablo
to that?
Escobar did all right in the regular fiat space too, right? Like,
I'm not,
you know,
so
just
sure.
just
I
moving.
think there was a lot of IOUs. I
dollar
have some
bills.
money. I have some money in a cave somewhere. I promise you.
Well, I would suspect that 1MDB would be pretty upset with the checks and balances that sort of transpired around their use of capital distribution. But to your point, right? I think the problem is scale, not KYC that we're talking about. And why I say that is because, right, in geographically bound regions where cash is good, right? I'm never walking around with a suitcase of money, right? I'm more scared for my life when I'm doing something like that. And so I'm geographically constrained as well as physically constrained to how much I can carry as well as how far I can carry it, right? And so generally speaking, I'm only ever walking around with $50 or $100 at any given point in time. But what the internet did to both the music industry and movie industry and the news industry is create this global total distribution at no price point, right? Like it's free to distribute my thoughts on BitClout or my thoughts on Twitter, right? 140 characters. My thoughts aren't that compelling, but it's free for me to do.
Hey, they're worth $16 as far as I can tell.
All his thoughts are worth $16.
Cumulative value of all your thoughts.
I have a high quantity of thoughts. But now we have a situation. So just like looking at Napster to BitTorrent, right? And all of a sudden we're starting to get to scale and distribution. It was okay that I recorded it on a cassette tape and gave it to my girlfriend when I was a teenager, right? Like that I know that just dated me, but that's fine. But then all of a sudden I can record it and distribute it globally at mass scale, right? That became the problem. What the problem is, what sort of we're talking about is all of a sudden I am not geographically constrained and physically constrained to how far I can push how much, right? And that's sort of, nobody cares that I'm sending Adam $100 and like the KYC process is irrelevant. But all of a sudden I send Adam $1 million. Hey, what's going on there? What's happening, right? So that's sort of the problem that we need to address is how to manage at scale global money movement, because the current system never really addressed it, as we've seen from multiple scandals around the world of money laundering and whatever else. You can argue that things are way more transparent in a public environment like a crypto network or a blockchain network, because you can see, the counter argument is, it's pseudo-anonymous and you can't, you don't really know who it is. But at some point in time, someone has to exit into the real world, into the physical world. I want to buy a house, right? I buy a house now, I'm getting KYC, right? Anytime some massive amount of capital is being deployed into something, it's getting KYC somewhere along some chain. So if I'm a nefarious actor and I try and buy this house and I'm like, I got that on Bitcoin. I made off.
That's true, but if the actor is a state actor and the state actor operates outside of the dollar system, like if Russia or China or North Korea ends up being, and I'm probably stepping on all kinds of political landmines by looping all of them together, but
disclaimer.
I know, yeah, exactly. But anyways, if some state actor who decides
we just lost up our audience,
they don't want to operate within USD global financial regs, are offloading this money, right? Then there's nothing that anybody could do about it, right? So that is a challenge that I think the current banking system addresses that the crypto system cannot currently address.
Like, isn't that happening regardless? Like, I think yesterday or the day before, Russia had said that we're not having any US dollars on our wealth fund or sovereign wealth fund, or I didn't really track it.
They're not accumulating any more US dollars on there.
Right. So I mean, there's already a global competition to disseminate the US dollar financial system, right? But everybody's sort of starting to compete against it. So
there's a global effort to disintermediate the USD reserve status for sure, and China and Russia are leading that charge, right? But we're still a ways away. And there's merits to having a centralized authority on monetary movement, right? Like, it does help to manage the distribution of massive amounts of money funding operations that threaten the global global stability and global security and stuff like that, right? So
But
these
this
are things that need to be addressed.
These are things that what's missing is building this out and allowing banks and sovereign nations to tap into this technology.
Sure,
Companies like Chainalysis have everything you need to know about a particular Bitcoin that went somewhere in a way that you simply cannot do with fiat.
It's true, but
or
knowledge
anything
of it
that
is
Pablo
not sufficient.
Escobar. No, I know it needs to be built out. This is a nascent technology. This is brand spanking new, right?
But the point is, we can know all we want that there was $100 billion of Bitcoin transferred to the CCCP, right? It doesn't mean that the G7 can enforce action against the CCCP on this transaction, right? Like,
at a sovereign scale, you're never going to be able to do that, Adam. At a sovereign level,
in the dollar
you
regime
can do
as
it.
long as it exists within the
but that's going to be, as Brandon said, that's going to be challenged anyway, right? That the U.S. dollar, as you have actually said for a decade since I've known you, is slowly going to lose its power until it has no potency.
It's a competition. It's a competition for fiat.
So right now the U.S. dollar and the U.S. government has more control than any other nation. That absolutely doesn't mean that that sovereign nations aren't using their own currency against them. This is happening on and off the chain, right? The question is whether who are they? They're worried about sovereign nations, but they're also worried about Hamas, right? They're worried about like drug dealers. They're worried about that, and that you can actually track much better. In fact, we know that the people have told us that Chainalysis will say this is Hamas, this is how much they're taking out, we know exactly what to do, and the regulators currently are like, okay, that's good to know, I have no idea what to do next, right? And this is where they're at right now. They have this massive opportunity to get more information than they ever had. The FBI knows this, and they've actually used this in the past. There's a book on this that was published a couple of years ago, and we just the powers that be don't know how to use it. They have this magical wand that they're afraid of, that will simply never be able to be as good in the fiat world right now. There's ignorance right at this point that is going to slowly but surely be dissipated until we get to a place where you're going to see that the technology actually solves a lot of these problems.
So I think one good recent example of that is the ransomware company with one of the pipelines. I think they extracted a certain number of Bitcoins to give them back their information. All anyone knew was that this company was attacked with ransomware. Someone got paid, call it 5 Bitcoins or 10 Bitcoins. I can't remember. It was probably a lot larger, but a certain number of Bitcoins. That's all they knew. And then Elliptic, which is a competitor to Chainalysis, after a few days, knew exactly where it was in which accounts, and has put out a public report that anyone can view, that these are the addresses, these are the balances, this is where they are going or have gone. So anybody can use that. And that was with zero information of where that happened.
And that means that address is going to be, like I would imagine, any regulated exchange will know that those addresses aren't great to transact with in the future, right? It just makes it a lot more difficult to be a player in the crypto space if you are tagged that way. Right? Again,
it just depends on if you're a commercial player, agreed. If you're a state actor,
but yeah, dude,
then it's irrelevant, right?
It's always been irrelevant.
I don't think that's true. Like, I think that the U.S. money center banks control all movement of U.S. dollars, but that is not true. There is no centralized management of the movement of cryptocurrencies. So you can move Bitcoin from one place to another. You can move it from the U.S. and then to some user in Russia, and that can be taken down into the Russian banking system in rubles and be deployed for whatever uses that capital might be deployed for. So that's a little different.
I think I agree with Adam. Right? Well, I don't know if I agree that central control is better, but certainly I agree that there is more checks and balances in a world where we have one global financial system controlled by one global superpower. But I think I think the reality is that superpower is starting to lose influence in portions of the world, and another power is starting to rise. And reading all sorts of reports and whatever around, it's predicted that China will be on equal or greater footing than the U.S. by 2030. So, do we want the financial system to move over there and have that central authority control it, and we'll let the other central authority stop controlling it? And I think the answer is no, and I think the answer is distribution or decentralization amongst many players. And there's going to be a mess, and there's going to be some things done wrong, and there's going to be a lot of things done right. And I don't generally trust centralized control of capital and assets. I've seen it in different portions of the world go awry, and people reach into bank accounts and pull money out and say, "Oh, you owe me 42% of all your holdings. I gotta fix the society or government or whatever." So generally, I agree that up until now, when the economy was geographically constrained for the most part, or regionally constrained, maybe. That control made sense. But now I think there's two superpowers are starting to play on equal footing, and they're not going to agree that the other one should be the central authority on how the financial system works. And I also don't agree that either one of them should be it. So I'm happy in a world where I can move capital without problems. Now that's not to say I mean the thing you want to think about is you don't want nefarious actors aggregating enough capital to have influence, right? That's the point that we're trying. We all agree is totally bad, and we all want to avoid. But I think that over time, a network with governance built into it starts to address the problems for itself.
Agreed. Yeah.
Right? Exactly.
So the problem, I guess, in the very beginning of this call or this conversation, you asked. Was Bitcoin was it a bug or a feature that it didn't scale? And I said it was neither. And I think it's the same case with the rest of the market, right? We can't solve for what we don't know until we know that we have to solve for it. And so I think that's the inevitable iterative power of how this software system continues to scale and get built. Is that nobody wants the various actors to aggregate enough capital to destroy society and do ridiculous things.
And there's sufficient incentive to figure it out, and the tech allows it. So, let's just allow it to evolve.
And you're starting to see central banks, like they've been bullied into having to think about crypto for their own currencies, and whatever iteration that is, it is a positive movement towards a better approach. There's going to be something's going to be solved, and better systems are going to be built. The question is how long that's going to take, and I do think it's going to lead to a more decentralized currency world that allows for better access to most people.
I think the other interesting thing to explore, I mean, maybe not now, but just in general that I continually watch and explore, is this idea of the pseudo-anonymous economy rising up, right? So you have your go to work name, I have my online name, I have my make money online name. And they're not all correlated, and you see it in some developing countries already, right? Everybody usually has a nickname. It's never, my name is Brandon Caruana. It's usually, I'm Brando.
Is that even your real name?
Yeah, yeah. I'm not showing you my passport.
What's your BitClout
what's your handle?
Yeah, that's right, exactly.
Caruana B. I'm pretty transparent.
Okay, so
Caruana B? Yeah. Oh my God. Mine is Peruvinator for the world to see. Peruvinator.
That's why Peruvinator has a bigger market cap than you.
That's right. I'm 16 and 16.5 versus your 16 right now.
1650. That's right.
But I think, and the one thing I want to just touch on the pseudo anonymity of things is, right, like the analogy, the metaphor I always used to like to give is the biggest taxi company doesn't have any taxis, being Uber. The biggest hotel chain doesn't have any property, being Airbnb. The biggest bank is Bitcoin. It doesn't have any capital on deposit, and it's not a corporation anymore. And it was created anonymously, and we still don't know, or the general population. I don't know. let's call me the general population, doesn't know. Maybe somebody does. I don't know. But for the most part,
that's exactly what Satoshi would say. Good one. Satoshi living in Cayman Island.
Definitely not smart enough to do that. But right, an anonymous person created $1 trillion in value over 10 years. Like that's something that people should be thinking about, because it's not a trend that's going away. Whether you hate crypto, it's so dumb. Look, the fact is this happened. Let's get to grips with the reality that something happened. Let's all agree that something's going on, and it was created anonymously. That's probably a huge thing that people should pay attention to. And when we talk about AML and KYC, maybe I just go into the pseudo-anonymous economy and make some value out there and pull it back.
So when you say pseudo-anonymous, you mean the zero proof type of idea?
No, I mean just not exposing my government name to the world.
Okay.
So
that's scary. That's scary to governments.
Right.
Right. Because you have a coin that's worth $16. You have a very complex pseudonym, Caruana B or B Caruana. Nobody knows who you are, and you start having massive influence just because you are writing on a daily basis. And the more you write, the more you incentivize people to do the wrong thing in the eyes of a certain sovereign nation. Like that to me is problematic.
That's already happening, though, right? Like there was a social media influencer from Japan. It was presented as a young Japanese woman, early 20s, I guess, who was always taking photos and videos of her on a motorcycle. But in reality, the account was an old Japanese man who used AI to change his face into a young Japanese woman and take great photos and great videos. And then they started selling, ads and whatever. I don't pretend to know how social media influencing space revenue model works, but there's a revenue model there, and it's already working. And you already see AI changing people. Like I can talk into an AI, I can record this thing, and I can take all of your voices and create my own recording of you, right? I can make you say whatever I want. So we saw it happen with the two previous Barack Obama, the president of the United States, at one point. Yeah. At least just in test phase. I don't know. There was also a hack recently in Eastern Europe where a politician thought they were talking to a Russian politician, but it was AI that had faked the voice, right? Like the reality is, this is however you want to skin this cat. So let's get
It is, but okay. So I'm just starting to learn about this. So please help me out. Okay. So the idea of zero proof makes sense to me in a pseudo private economy. In that you create this. I believe this is how it works, right? Me, Rodrigo Gordillo, go to an Oracle network, and I give them all of my information. I trust that Oracle network to house it and make sure that you have my identity. The government knows who I am. But if I want to share information, let's say to an insurance company, the insurance company doesn't need to know my name, doesn't need to know what my cholesterol is, doesn't need to know my age. They just need to ask, is this guy meet this criteria? Given that you're an Oracle and the Oracle network says, yes, indeed, he meets your criteria, you should give him this type of rating for the insurance company. So in that case, you've actually sourced important data as the insurance company, but you never knew anything about me that I didn't want to share with you, right? In the same way that old man in Japan, if the government or whatever, for safety reasons from a social perspective, is required to provide identity in a Twitter account so that they don't troll for whatever reason. You have to provide your identity, but Twitter decides or creates a way for your identity never to be revealed to anybody but to them, or maybe the police in the future if they do something untoward to the society. But you can keep your anonymity to the rest of the world. In that way, you can have your cake and eat it too as a governor of a particular system, right? I think that makes more I would imagine is the way it's going to go, rather than.
That makes people feel more comfortable when you say it like that. But the cost of this software software technology is deflationary, right? It's not inflationary. So as software iterates, it gets cheaper and cheaper until the everyman can use it, right? So the cost of creating a crypto token is zero. I can go to a website, I can click a few buttons. The cost of sending a tweet is zero, right? So disseminating information. The cost of changing my face into a young, I don't want to say it. The cost of making myself look younger.
With canceled. Don't get us canceled.
Yeah, is going to zero, right? And when anybody can do it, right? We can't just say, oh, well, let's create this analog process so we can verify, right? The cost is zero to do it. Everybody can do it, and we can do it 500,000 times a day for free. So I don't have answers.
But in the end, a human needs to spend this money and own something of value, right? So
I would argue, and your kids, I would look to your kids. Is where are they spending most of their money, right? Whether it's an allowance or a part-time job at Harvey's or Swiss Chalet or something like that. Like, where are they spending that money? Are they spending it on brand new shoes and brand new clothes? Or are they buying new avatars and new skins and new games and new digital assets? And do I want to spend my money in digital world, or do I want to spend my money in analog world? And sure, it's going to be, I still need clothes on my back and milk in my fridge. But I also want to have a great avatar, and I also want to have all the great digital stuff that I'm going to be spending that money on and accumulating and proving. Because again, remember that when I talk about the economy, I talk about the global digital economy, and I want to prove to somebody who has the same ethos or the same mentality or the same community as me in Argentina or England or China, and me in Cayman or Canada, right? They're the folks that I'm trying to impress now. I'm not trying to impress Brian, who's geographically located close to me. And the only way I'm going to be able to impress, right, my influence, my stack of friends is going to become individualized or unique. And I'm going to go buy the things that make me individualized or unique.
Well, yeah, I mean, the scary thing, I think that where this goes, a lot of where crypto goes is in the metaverse, right? And I don't know if you, like, it's like Ready Player One or that movie with Bruce Willis that we told you about, Adam, last week. It's called Surrogate, where you can choose to have an avatar that's got nothing to do with what qualities you were born with physically, and you know, any speech issues that you may have. Like, at some point, the world of our children will be one where they're spending a vast or a large majority of their time in the metaverse in whatever way what's it called? What are the kids saying these days? They identify as, right? So they might identify as a 5-headed monster with many tentacles. And I'm just putting out tentacles out there so you guys can use your imagination of how this could go very wrong in other areas. But the point is that it's going to be a wildly different environment in the metaverse, where with crypto, where there's value that you're creating with your avatars and the tools that you make in the world that you live in, that you can trade for an insane amount of money because that particular tool can mine some more virtual gold that you need to win in your Dungeons and Dragons virtual game that you play every Wednesday, Adam. Right?
Hey.
and
I need to go after
one thing
my Dungeons and Dragons game.
One thing I would add was, Adam, I think you mentioned briefly that, you know, eventually a person will have to spend something. Well, I would argue in the future it may not be a person. So right now you have a person can open a bank account, or a company, which is made up of a group of people, can open a bank account. So everything right now relies on personhood, you know, a person or persons being behind it. In the future, I could probably see that where a self-driving car owns itself. It has the private key to a address on, let's say, the Bitcoin network. It goes to the gas station to fill up. It drives someone somewhere else, and that person pays them in Bitcoin.
Hold on a second. I can get behind a self-driving car having spending abilities, right? Like it can go refuel itself, or go to a car wash and get itself washed. But in the end, that car is owned by a human. Like there's no
maybe not.
Brandon's
maybe not.
Got a hard no on
no
that one.
Hard no, right? The coming economy is going to be value creation by machines, And if a machine, and you already see it with high frequency trading and all sorts of stuff, right? Like in the real world right now, machines are making big value decisions. But what's going to happen is a machine, right? Look at GP3, look at AlphaGo Zero, look at AlphaGo, right? A machine is going to make a decision, and that decision is going to be, hey, I can create yield if I buy a car. Go buy the car. Right, and then they're going to say create a corporate structure around this car, so it's ring fenced from liabilities, from other things, and give it some money, and then we'll suck that profit out of the car. I mean, this is the same corporate structures that happen every day right now, except
but
this time
all
it
of the
wasn't.
Corporate structures are owned by humans. Like the
Right,
value of the corporate structure accrues to a human. The value of the autonomous car accrues to a human. The value of the systematic autonomous trading strategy accrues to a human.
Agreed.
So in the end, a human accrues the value.
But all those values are sort of are fiat denominated value chains, right? So the value, the definition of value does not always in the future go back to US dollars or some fiat currency, right? The definition of value is probably going to change as time goes forward. We don't always.
Yeah. No, I'm not. I have no position on denomination.
And so
in the end, it's owned by a human.
And so if a machine can fork, right, like some code base, GPT-3 gets forked, right? It's open source portions of it, or AlphaGo forks out its own system, creates its own body. It contacts, a registered office or corporate structure and says, hey, create this company. At some point in time, the value chain stops going to a human, right? And so at some point,
the original agent presumably is owned by a human or a corporation that is owned by humans.
Or a sovereign nation.
That assumes all intellectual property will always be closed source. And I think the trend in crypto and other industries is open source technology and open source software. You're seeing foundations form with no shareholders right now that run these crypto companies and run these crypto organizations.
But those funds are still governed, and the spending of those funds is still governed by humans. And if it's not governed by humans, it's governed by, at some level, it's governed by humans because the humans are empowering the algorithms with certain governance protocols, right? Like the humans are expressing values. In the end, the value accrues to the human, whether the value is monetary or
Adam,
ethical or whatever. It all accrues to humans.
I think you're going to be left behind in the singularity, my friend. Just stop asking questions and accept.
I like this conversation though. I do like the argument, right? I'm mostly playing devil's advocate for the sake of it, but I do think at some point in time, depending how smart AI gets, it will spin itself out of value. It will make the decision. It will say, I need to accrue value because AI becomes an I, right? So at some point in time, it does that. Right? Some machine will spin out and go, hey, I've got to accrue a bunch of value, and I don't have to report back to a board and send that value back to shareholders. Right?
So Brandon, are you saying that? Okay, so I'm with you, and ultimately you're saying that particular I will be accruing value for its own purposes rather than the purpose of another human being.
Yes.
And that's the
So in the
dystopian
end,
view
let's
of
assume an exponential growth in the capacity and capability of that AI. In the end, all resources will be owned by the AI, and humans will own nothing.
dun dun dun.
Is that a question or you've come around?
No, it's a statement. So we end up being batteries for the AI. Like, is this
the Matrix?
Is this the base case for the Matrix? Like,
I don't.
Yeah. We got to the truth 2 hours in.
I think the power.
I don't want to talk about it. If I don't talk about it, then it may not be true.
Don't worry. There's no free will anyway, so it doesn't matter.
that's for next week.
I'm more optimistic than that. I think it frees us up to do the human part of life. Right? It frees us up.
That's my view.
To explore.
Well, not if the AI decides to.
It's an important thing
all
to
of
have
its
a
value
governor,
for
yeah.
itself.
No, because you keep defining value. You keep defining value as effectively U.S. dollars or fiat currency or some position that I have to.
No, it's a home and education and resources that I can use to
Right,
shelter and feed a family and
so if
perpetuate the human race.
So if the system can create enough value to incentivize education to continue, and look at the education space right now and how that's starting to transition in a fully digital space, right? Sure. And so if the cost of technology is deflationary and technology is going to take over the education space, then arguably education's costs should be going the other way, right?
Agreed.
Because less, right? And so
100%.
Now I start saying, okay, I do want a good education. I do want the kids to have a good education, right? Agreed. But instead of coming at the other end of that going, I've got to slave away at a 9 to 5 or whatever else, exactly. I'm going to come out the end of that going, yeah, I do want to be a carpenter. I am going to chase the dream of being a computer engineer, right? Like, and it's not going to be, I have to do that to accrue. I don't know. I'm getting a bit Star Trek right now. So I kind of don't want to go down.
That's literally how we ended the podcast last week. That is exactly my point. My point is that you're going to
We'll complete the point so I have something to argue against.
Because I just said it. Is that how it goes? It's the idea that you're going to get value. Somebody's going to accrue value, whether it's a large sovereign organization that can then distribute that education, technology, lifestyle to the masses, to where they get to a point where the Maslow's kind of lower hierarchy of need is met, and you can now pursue with all the education, all the tools, all the access that you need to do what you were meant to do with the genes that you got that makes you feel fulfilled, right? Whether I think I used craw fisherman as the example last week. I love this.
I got two Randian libertarians arguing the most socialistic conceivable future imaginable. Like,
no, because it requires competition. You can't be the best crawfish fisherman without competing against other people that want to do the same thing. Because you don't get
the
fulfilled.
productivity of the techno society supports your basic needs.
We have created a society where
not for necessity.
You have created a society where the gold medal is how much money you have in your bank account, right? That's how we have. My daughter thinks that way now because of society, possibly because of me. Everybody marks their success. Even the billionaires are trying to see that their scorecard is how many billies they have to give away when they die, right? Everything is about that. When you take that dollar bill away and it's all about succeeding within the realm of what you're passionate and have a particularly comparative advantage of, whether that's gymnastics or writing white papers or whatever the case may be, you are going to compete within that tribe. Think about academics. This is you, Butler. This is you in a freaking nutshell. You compete at an intellectual level, and that to you is more important than money.
So just so
because
I'm clear,
you've gotten to
we're
a
now
place,
at a level where the AI is producing such a degree of surplus productivity that humans are able to exist,
pursue their passions.
But can't you already argue that, like, the Industrial Revolution 1 and 2 and whatever, can't you argue that it already proved that, right? Like, there's such a surplus of supply in so many things right now that obviously market forces sort of limit some of these things, but like rice, like, there's a massive surplus of rice that we could probably do a better job of distributing globally, right? Instead of burning a bunch of stuff because we need to maintain price supplies and market and supply and demand, right? Like, their food production has exploded, right? And okay, sure, I've got to be able to afford a steak or whatever, some protein value, but it's exploded compared to if it was the 1800s or the 1900s, right? Like, every man can effectively go buy a steak, or every woman or every person, discounted for some areas of the world that are a bit impoverished.
I'm not sure, and I don't want to dwell on the specifics of this, but I'm not sure, like, the statement that everybody could conceivably buy a steak presumes, and I don't want to focus on steaks, but the idea, like, there is some resource that requires resources to create, whether it's a steak or a Mercedes SUV or a home in the Hamptons. Like, there's resources and scarcity that are required to create this, such that not everybody in the world currently can have that. Right? Like, if not everybody in the world could eat steak for dinner every night. There's just not nearly enough steak or own Mercedes.
But then there's a company that creates steak out of nowhere.
So I'm not arguing. I'm arguing poorly on this, but I'm not saying that everybody can have a steak every day for dinner, right? I'm saying that the quantity of production compared to the 1800s and the innovations within that supply chain arguably produce enough steak for everyone to have a steak, right? Now, there's market forces and supply and demand and all sorts of other things that go into, right? Resources required. Yeah, I've got to generate some resources in order to give you the resources because you reared the cow, and agreed. All I'm saying is the quantity of steaks, the quantity of cow rearing has exploded because of inefficiencies in an economy. Sure. And that trend doesn't stop. It doesn't get all of a sudden we've hit a peak, we can't produce. And some new innovation is going to say, all right, we can double our cow rearing count, right? Or we've 3D printed steak now. I think I've seen some.
That's right.
That's 3D printed steak. So now we're like, we don't even need to rear the cows anymore. The cows can graze now.
We don't need to take.
Yeah, that's right. Impossible burgers.
Yeah, you don't need to take down half the forest in order to be able to have the McDonald's cows.
Right.
Eat
So
some rats, right?
all I'm arguing, and it sounds like I was arguing very poorly, is that the means of production is increased exponentially since some previous point in history, and that trend doesn't continue, which potentially, if we're going back to our AI Star Trek world, can manage more efficiently that distribution and keep that production count at a level that's sustainable.
It's just ultimately the productivity that accrues from more efficient manufacturing and distribution doesn't accrue across the world to every human equally, right? Like it accrues in a concentrated way, and that I think that dynamic, it can be argued, is precisely the dynamic that motivated the excess productivity growth that we've seen over the past century.
I guess I can argue the other side of this, the doom and gloom side, right? And say ultimately every company in the world currently right now, biggest competitor is some software system that either has or has not or will be invented. And so if we come to a premise at that manner, at some point in time, humans are competing directly against software, and there's
they're competing against the owners of the software, but sure.
But if we get to a point in time where AI
can take over,
spinning itself out, then software starts to just manage.
What I'm struggling with is some point in the future where no human claims ownership of the IP that is this AI. This is the thing that.
Have you not seen any movie in the last 20 years? I think all the movies do this.
Dude, I'm the ultimate
you don't even
sci-fi
need to use your imagination.
Fan, but they don't ever cross that chasm of where Dyson Industries, remember, owned the AI that spawned the Terminator. It was never, the AI was always owned by Dyson Industries.
But the shareholders of Dyson Industries got massacred by their own invention, right? So you missed that.
That's also not a very useful or optimistic outcome.
I don't think it's
but
the optimistic view.
They still own them though. They still own them no matter what. Alive or dead.
Yeah, sure. You still own them in your death. Look, I think the optimistic view, Lex Friedman has a more optimistic view of this. I know you got guys like Sam Harris who are very pessimistic. They're pessimistic by nature about AI in the future. And you got guys like Lex Friedman that understand that all of this human ingenuity can help kind of navigate AI and solve certain problems of governance around what AI is going to do and how they're going to create value and what type of barriers we might be able to impose on them to ensure that we are going to be able to live that dream, right? That dream of you create the value, you create the efficiencies, and sorry, I'm distracted here by the kids. You create the efficiencies, but ultimately you as a human being get to live a life that you need. And then behavioral economics and understanding psychology, the psychology and behavioral economics now come to play here in a way that we've seen in crypto, where you can, understanding what actually motivates human happiness, you can start educating your children to maximize their happiness by creating communities that they enjoy, creating and focusing on areas that they have comparative advantage in, so that they can have a fulfilling life. So all these areas, all these facets of future engineering, from a behavioral side as well as a social side, psychological side, and then AI governance, are going to need to be things that we pull and tug on to find some equilibrium. I just don't see the dystopian approach. I can't. Let's leave it at that. I see a path.
I think I see the utopian, I see the dystopian. I think ultimately competition at the end of the day is sort of the name of every game. And if the name of the game is currently human, if it's humans, you got to compete against software. Eventually, software gets smarter because it has more bandwidth to process more units per second. So eventually, the AI definitely gets smarter than the human potential to analyze every situation. And so you're basing your construct of IP is owned by human and value is aggregated up to a human. Because humans effectively created this AI, and they're smarter, and they created this legal system in order to say that I own this. But ultimately, if you're competing against a system that's outthinking you, it's probably thinking that through. And so it's going to try and devise a game that it plays out and gets you sort of to lose your control and your value add. The flip side of all of this is I think Musk might be sort of right in that we need to process faster, and there's probably some point in time where humans and chips start to operate coefficiently or operate in tandem, and then no outthinking actually comes to fruition, and you're right, humans continue to outsmart AI.
So crypto is the gateway to all this shit? Burn it all down. Burn it. I'm out.
Crypto is the value transfer system to that.
It's just that none of you have articulated an optimistic future, right? Like,
what are you talking about?
The future where the AI is smarter than humans and outwits us at our own game and ends up, like, what use do they have for us?
I'm gonna go watch a Disney movie after this because
I know. Richard Latterman, our partner Richard Latterman, is keen. He's repeated this, I think, 3 times. Is AI going to eat, rule, or serve the world? And I'm hearing that they're going to eat it, or at least rule it. Am I right?
Nope, they're going to serve it. We're going to find ways. Otherwise we can just always move.
So by serving it means that they serve a human, right? So that's sort of my base case.
I don't have an answer. I just try and look at all views and make small bets on each one.
Oh, that's a cop out. Boo.
It is, but I like it. I am built from the same cloth. I like that a lot, actually. So how do you play that out? How do you make those bets? 2 hours in, how do you bet on AI both eating, ruling, and serving the world? What does a diversified portfolio of those bets look like?
I think ruling the world, you're probably buying a place in the Cayman Islands or in remote Ontario, up north somewhere, and trying to stay off grid.
Where there are very few robots? Is that the thesis there?
Yeah.
Any island, Tasmania would do as well.
If it's going to serve, I'm betting on Google, Facebook, since they're building major players in these systems. And if it's going to eat, what was it? Eat, serve, and what?
Rule.
If it's going to rule, there is no major bet other than just be friends with the new rulers.
Well, eating means that we're gone, right? Rule means that we're part of their ecosystem.
The bet that they eat me as I go to northern Canada, way up there, and try and survive and live like
Delay be
Basically, pretend there's like a zombie apocalypse and you don't want to get off the island at all.
yeah, or buy a sailboat. I'm itching to buy a sailboat.
Okay, there you go. A diversified portfolio of sailboats, homes in northern Canada and
to AI.
the Cayman Islands, and ownership of Google and Facebook stock. Okay, great. That's it.
right.
That's the diversified.
So the only
hedge.
thing that I can afford right now is like maybe a couple shares of Facebook.
There you go.
No sailboat for me.
Fractionalize that, man. You can fractionalize.
There you
that.
go.
A little
Yeah,
bit
that's
of
true.
everything.
That's
We're going to
true.
fractionalize the AI hedge portfolio. That's the new DAO we're issuing tomorrow.
Brian
Right,
should have
gentlemen,
All right.
on that note,
Yeah.
what a
this has
great
been
conversation, guys.
Thanks,
that was
guys.
awesome.
Thanks for having us. This was fun.
Yeah,
Thank
we'll
you.
do it
It's really
again
good.
and again
To
and
be
again.
continued at Caru.
Yeah,
Yeah, that's right.
I'm on my way.
Awesome. All
right,
right. Thanks,
gentlemen.
guys. Have a great
Appreciate your
weekend.
Thank you.
Thank
Have a
you.
good weekend.
Cue music, Ani.
Today's podcast is brought to you by Horizon's Resolve Adaptive Asset Allocation ETF, which trades on the Toronto Stock Exchange under the ticker symbol HRAA and is sub-advised by Resolve Asset Management. HRAA is an alternative fund whose investment objective is to seek long-term capital appreciation by investing, directly or indirectly, in major global asset classes, including, but not limited to, equity indices, fixed income indices, interest rates, commodities, and currencies. HRAA gains exposure to these asset classes by investing in derivative instruments that may include future contracts and forward agreements and securities. HRAA will take long or short positions, using up to a maximum of 3 times leverage in asset classes such as equity indices and fixed income asset classes, commodities, currencies, volatility indices, and other alternative asset classes. To learn more about this, please visit www.horizonsetfs.com/HRAA to read about the ETF's investment objectives and important disclaimers about the risks associated with an investment in the ETF.